Welcome everyone to the special event by the High Performance Assessment Realty Forum magazine. The future of 1031 exchanges are managed with our special guest, the managing partner of Damascus Partners, Joel Desilets. I want to welcome Joel to the special webinar presentation. He's going to share his knowledge on the future of 1031 exchanges.
Thank you again, Jason and Linda at Realty 411. Greatly appreciate the opportunity to share our perspectives here today, and I'll get right into it. So our belief is that modern 1031 exchanges are best suited to be comprehensively managed with an institutional thesis versus by the traditional transactional mindset, kind of just dovetailing from property to property. Our belief is that this trend will continue and 1031 exchanges will be increasingly managed into the future. So I'll lead off by sharing our story and why we created the Damascus Partners Family Office in the first place. So we created this firm with the aim of positively impacting other people's lives and helping them create more time freedom and security, especially in the areas of real estate investments, and especially in the areas of large asset transactions in tax efficient manners. So we achieved this with our strong focus on education in the areas of commercial real estate, land banking and infrastructure development, residential housing construction, multifamily apartment communities, both new constructions as well as value add repositionings of existing communities, and institutional quality hotels and other hospitality projects. So we found that there is a real need for more comprehensive educational materials and conversations surrounding how to build truly diversified portfolios that achieve the full spectrum of asset classes across ideal geographies with no compromise. And so I thank you for joining me in this conversation, and I appreciate the opportunity to share our thoughts here this afternoon. Anyone watching, I look forward to connecting with you on the phone. You can reach out to Jason or myself, and there should be a calendar link alongside this video as well, and I believe in the chat. When we speak, it'll be great to learn more about each other and discuss any aspect of investment real estate, and especially 1031 exchanges in greater detail as they may apply to your specific situation and long-term strategy. So we'll lead off with a little bit of history on 1031 exchanges. When selling any highly appreciated asset, such as real estate or even a business, it's always beneficial to consider any implications resultant of the sale towards your tax situation, as well as estate considerations. As many of us know, and many of us have executed numerous 1031 exchanges over many decades, Section 1031 of the Internal Revenue Code, or IRC, states that for investment property exchanged for like-kind property, taxes on capital gains can be deferred. This makes a 1031 exchange an excellent wealth building and preservation strategy. 1031 exchanges have existed in some form since the 1920s and matured throughout the past century to become what they are today. By 1990, the modern process was solidified, involving a qualified intermediary, or QI, the 45-day identification period, and the 180-day exchange period rules that we're all familiar with. Perhaps of the greatest significance to our conversation today, the Treasury Department's rulings throughout 2002 and 2004 paved the way for fractional interests, tenancy in common or TIC structures, and DSTs, all of which allow investors to achieve the highly customized solutions available to be strategized today. And that's what we're characterizing as managed solutions versus simply going out there and exchanging one single family investment property for another one, or one duplex for another one, and things of that nature. So top concerns, different asset classes and strategies. Let's examine the top concerns that are most important to investors and business owners and which influence the decision if and when to sell. We understand that's not always a cut and dry decision. So the timing of the sale is very important. And by that, we're talking about the seller's timing, the investor's timing, when they want to sell it, the desired sales price, tax impact, cash flow. And for cash flow, we're talking about the cash flow typically through rental income that is being realized by the seller prior to the sale. estate planning, passive versus active management. And then when you go to find your replacement asset, are you able to purchase it for a value, for a good price? Is the asset you really would like even available? And how's that asset going to cash flow? Last but not least is the 1031 exchange execution itself, which is of course vital because you need to make sure that it goes through in accordance with the tax code so you don't have any problems down the road. So in a traditional transaction, and we're going to try to differentiate between a traditional transaction and a modern managed form of solution, which we believe represents the future of 1031 exchanges. In a traditional transaction, the seller manages all of the above themselves within their organization, if they have one, and in coordination with qualified intermediaries, tax attorneys, real estate attorneys, and estate attorneys as appropriate. Typically, even though there are often more than one property under consideration, properties are strategized one by one sequentially versus cohesively. Many people have been comfortable with this for a long time, but ultimately that means if you wanted to sell all of your assets at once or transact out of a number of assets all in 1 year, in many cases, folks will find themselves taking much more time to accomplish that. And that's because of the sequential nature that tends to be utilized. In a managed solution, the seller engages with a firm such as ours or a number of others out there, specializing in strategizing asset dispositions. And together they develop a comprehensive solution for all of the properties that addresses all of the above concerns and utilizes in-house counsel for simplicity. At least we do. In many firms, a lot of that might be outside third party still. So let's walk through some of those top concerns, starting with timing, price, and net benefit. So timing of the sale has many variables. We have depreciation benefits, mortgage leverage, estate planning, all the way to finding the right buyer, the buyer's timing, which in many cases may or may not align with the seller's preferred timing, and the buyer's offer. So are we getting the value at the sale that we want to achieve? So in a managed solution, specialized management firms can help take timing concerns out of the equation. So let's walk through a couple of these. The longer a property is held, the depreciation benefits are exhausted, which lowers the net benefit to holding. This is one of the reasons people will sell. How this pertains to timing is that as you approach the end of the depreciation of your asset, in many cases, folks will start looking for a replacement asset. So typically they might start looking into this over a period of months and sometimes years. The longer a property is held, the mortgage leverage benefits are also exhausted, which lowers the cash on cash returns. So typically when certainly a commercial real estate asset is purchased, typically leverage is utilized, could be anywhere from 25% to 30% down, and the rest would be on a mortgage. So again, that's one of the factors that impacts timing. The longer you hold a property, the lower your cash on cash returns actually go. And then lastly, often there are family and business considerations that are event driven. Could be a health issue in the family or with one of the partners. And these necessitate a sale. So that's an important impact. And you have to hope in many cases traditionally that the sale that you need to make aligns with the ability to find the right buyer, hope it lines up with the buyer's timing, and then hope that you're able to actually get the sales price from that buyer in terms of their offer. All of these variables often result in compromise to price and exacerbate the difficulty in aligning replacement properties. Next is tax impact and cash flow. So tax impact can be entirely mitigated if the right replacement properties can be had. And this is true for traditional 1031 exchanges as well as more cohesively managed exchanges here into the future. With a managed solution, specialized management firms can help maximize tax benefits and match or exceed your existing cash flow. Traditionally, an exactly sized investment property needed to be identified where there would often be a tax impact. And what that means is, you have to go with typically an equal sized property, if not larger. You have to make sure that you can size the equity from your relinquished property into your new asset. And you have to either match the debt note that you still have, if any, on the old asset, on the prior asset, or replace that debt with equity on the new asset. So all of that plays in. And if you're not able to do that and perfectly size everything, then you'll still have a tax impact on the sale, even if a 1031 exchange is utilized. Traditionally, one or more of the property owners or partners are utilizing rental income cash flow each month or quarter, and a disruption in those monies can create difficulty. So it doesn't have to impact everybody, but in many cases, that money is being utilized coming out the other side, and that can play, matching the tax flow can be a fairly important component. Modern 1031 exchanges are able to utilize fractional interests, tenancy in common or TIC structures, and DSTs to precisely size the replacement of real property assets. This helps ensure full tax deferral, and depending upon assets strategized in the portfolio, disruption to cash flow can be eliminated in most cases. That's a huge benefit of the more modern managed 1031 solutions. One of the next concerns is passive versus active management. Properties are always being actively managed. The question is whether it's being done in-house or the expertise and scalability of a specialized asset management firm is being utilized. So we're going to define passive as managed outside by another firm and active as managed inside. Specialized management firms can help achieve the same or better results as traditional in-house management with significantly reduced time commitment to hands-on oversight. Traditionally, as real estate investment assets are acquired, it's often cost-effective to manage hands-on. We're all familiar with this. Most, if not all of us, certainly have done this for many years on many of our properties. This is especially true when properties were smaller and located closely to the owner. Over time, as the amount of assets increases and their location spreads out, the most sophisticated investors will either build out their own in-house property management teams or contract with outside firms to accomplish the same. Either way, considerable time and money is involved. Modern 1031 exchanges are able to invest in whole or fractionally since 2002, 2004 in asset classes with much greater scale and cost efficiencies that more than cover the increased costs of outside management. And lastly, replacement asset considerations as some of the top few concerns. When deciding whether or when to sell properties, top of mind concerns always include what other properties may be available to replace them right now, and whether they will be able to be purchased for an attractive price. So value and availability and cash flow. Is the cash flow going to be equal or close? Is it going to work for everybody involved? Specialized management firms can help identify a replacement property or a diversified portfolio of real assets on your timing due to their economies of scale. This allows the seller to focus on achieving the highest sale price. Traditionally, sellers executing a 1031 exchange end up compromising not only their sale price, but also the price paid for the replacement assets. This is often outside your control, and while overpaying for whatever's readily available, we tend to justify that and say, well, we're going to hold this for a long-term time horizon. Ideally, there would be no compromise. Modern 1031 exchanges are able to invest in a broad spectrum of real estate property assets, eliminating the need to compromise on asset class and most especially location. For example, single-family home investors in California can diversify into multifamily, land banking and land infrastructure development, and even hotels throughout the Sun Belt, for example, in the Carolinas, Florida, Georgia, and you don't need to be next door to those assets. So we're going to talk about what are these assets that most folks are completing 1031 exchanges on. So I'm going to define these as traditional retail assets, which 95% of the time is what is being exchanged. Traditional retail assets are typically acquired one by one over time as the investor builds experience and wealth. Property selection is influenced significantly by proximity, simple availability, and capital timing. All of this is fine, but what you end up with is typically single-family homes. People who can pull this off really, really well tend to end up owning half a street or a whole street, or everything's in the same town. But many times they end up kind of all over the place in your general proximity. Mid-market apartments and triple net. So traditional assets such as single-family homes, smaller scale multifamily, and commercial real estate such as retail centers, these are excellent pathways to wealth creation. But as assets grow over time, their management becomes consuming. We don't have to tell anyone this. Everybody who owns these assets knows that. But more importantly, the investment thesis of the owner evolves. This is why most investors ultimately consolidate their assets and use this consolidation process as an opportunity to move into institutional quality assets and a more diversified blend of asset classes. Institutional quality assets. Institutional quality assets are typically acquired by more sophisticated investors. Asset selection is influenced significantly by ideal geographies, not proximity to where they happen to live, asset class diversification, security, tax strategy, and management efficiency. This can take the form of large-scale single-family home developments, anything 20, 30 homes, or in some cases, could be hundreds of homes and up, 500 homes and up in some cases. Class A multifamily and Class A locations, brand new constructions, sometimes direct from the developer in many cases. Traditional assets such as single-family homes, smaller scale multifamily, and assorted commercial real estate can be exchanged into institutional quality assets. These allow for greater scalability and growth and offer many economies of scale. For example, top builders in the country who construct tens of thousands of homes annually are able to purchase materials much more affordably and also weather challenging labor markets and interest rate environments more reliably. Another consideration is who will be the end buyer. Ultimately, the best and highest values can be achieved when institutions are making the purchase, such as REITs and pension funds. So we hear these terms a lot, but in practice, it takes a little bit to put together. Our institutional thesis is that as a more sophisticated institutional quality portfolio is built, again, typically through 1031 exchanges, that the prime focuses should be risk-adjusted returns, property diversification, and tax mitigation and tax strategies. And these are all things more than happy to dive deep into on a one-on-one basis with anyone who wants to have a conversation. So let's talk about single-family home construction. So many times people will invest through 1031 exchanges from one single-family rental home to another, and that works. However, in many cases, there's more yield to be made, and it could be more attractive to invest in the actual construction of the homes. This can take a lot of management difficulty, especially if you need to work with a smaller scale builder, and there's a lot of timing considerations that in many cases aren't going to line up with a 1031 exchange. It's just never going to happen. With some of the partners that we work with and some of the solutions that we put together cohesively in-house, we do have single-family home construction expertise. Typically, as long as you're not actually the builder, we're able to meet the objectives of passive participation, asset class diversification, because you can get into all sorts of different unit mixes and different geographies, higher investment returns once you take the friction out of having to go home by home when you're able to go into larger scale developments, higher liquidity. Oftentimes when you're putting work into a project or a home, you're renovating it, there's no liquidity for a little while. And in many cases, you don't have a tenant in there yet. And perhaps most importantly, I touched on earlier, preferred locations. You might live in an amazing area. I know I love where I live, but is that the best place? If you could choose between 2 or 3 amazing locations, including the one you live in, should you be continuing to invest in your current location? And in many cases, the truth of the matter is no. And that's why we believe in investing, and certainly we're fond of the Sunbelt markets. We believe they have some of the strongest fundamentals and forward-looking growth that exists in the country. These are vacation home and retirement destinations. Healthcare and education is seeing significant investment throughout the Sunbelt. So we're particularly fond of Florida, South Carolina, and North Carolina and Georgia. But high level, this is one of the asset classes at scale that should likely be considered for inclusion in an institutional quality portfolio for a 1031 exchange. Next is multifamily apartments. Many folks own multifamilies. They get their start with duplexes, 4 tops, 20 tops, small to mid-market multifamily. Many times these are, in most cases, these are existing properties, and various efficiencies and improvements can be made to the properties to increase the net operating income. You've got the rental incomes if you can manage them properly and keep occupancies up and increase occupancies. You can certainly do well with those properties, but typically they're less scalable in the ability to manage them. So with multifamily apartments, our thesis is 350 unit and up properties in A-class areas in the best, Sunbelt markets. Florida, Texas, Arizona, North and South Carolina, Oklahoma. In many cases, these are able to be done with outside third-party management firms, making them 100% passive to the investor. Multifamily apartment buildings do weather economic environments and cycles differently than single-family homes. We believe it's a very important asset class, especially in the current economic climate, and it's an excellent asset class to include in a managed 1031 exchange. Now, land banking and infrastructure development has primarily been an institutional grade investment class over the years. A lot of small scale developers, they're doing this whether they know it or not, simply buying a piece of land, starting to develop it, developing a few lots at a time, and or in some cases selling off those lots to another builder or a series of builders. Our thesis involves participating in land banking and infrastructure development at scale. Typically 500 home and up size developments offer the necessary scale. We want to be in the exact correct geographies. So land banking involves both purchasing outright and also securing with options contracts for the land development. The next step is infrastructure development, which involves preparing lots for actual homes to be built on and deliver them to the builders. There's also infrastructure development that goes into other asset classes like hotels and other hospitality projects. But primarily infrastructure development, we believe, is an excellent asset class when aligned with large scale single family home developments with the largest builders in the United States. Another asset class that's typically not included and not considered by most transactional 1031 exchanges is hospitality. Now, someone might not want to go from owning 500 apartment units to owning 1 or 2 hotels, but they might want that to make up 10, 20, 30% of their portfolio. Either way, it's certainly an asset class that should be considered when designing a fully diversified portfolio. Typically, cash flows and returns tend to be very high. They weather economic cycles differently than other asset classes. So we believe very strongly in participating in the construction and development of hotels and hospitality projects with prestigious brands and technologies throughout the Sun Belt as well. So I just want to thank you for the opportunity to share our perspectives on the changing landscape of 1031 exchanges. And we look forward to furthering the conversation one-on-one with you.